Thanks everyone for joining me today here in Washington, D.C. to talk about short sales. Don't forget to like and subscribe. All right, short sales. What is a short sale and how does it differ from a foreclosure? As an owner, you might be in a position where your house is worth less than what you owe on it, meaning that the market has gone down or that you over leveraged yourself over time and got a bigger loan. So for instance, your house you see is going for $400,000. Similar houses in the similar condition are going for $400,000, but you owe $500,000. Maybe that's again because housing prices went down. They were up in the 600s, but now they're in the 400s. Or maybe the condition is just a little bit different. So if it's not newly renovated, it has a lot of issues, that may cause a decrease in value. So let's talk about decrease in value. There's three main things. One, it could be a market, right? The market goes down, there's less buyers, there's less attention, your housing price will go down. Two, rates go up, and therefore the cost of money is a little bit more expensive, so your housing price goes down. Then three, maybe the condition of your property warrants a lesser price because it's as is and it won't get the same price if it was newly renovated. Let's say the kitchen hasn't been updated, there's a lot of leaks or a lot of issues, molds, waterproofing, a lot of the systems are out of date and should be replaced. This warrants a lesser price. Now, short sale is better than a foreclosure. Why is a short sale better than a foreclosure? For one, it doesn't affect your credit. So as an owner, you could do a short sale, meaning that you could sell for less than what it's worth and negotiate with the bank so it doesn't affect your credit. So the banks are negotiable. They are willing to negotiate under certain conditions. So for example, if you owe $500,000, however, you're seeing that in your neighborhood, a similar condition property is going to $400,000, maybe $425,000. That means your $75,000 differential between what you owe and what it's actually worth. You propose to the bank by doing two things. So the first thing you want to do is contact a real estate agent that knows the market very well. What I like to do is I take a look at the house and I see what we could sell it for, what an investor will buy it as is, because more than likely there are a lot of things to do in the property that would warrant a less price. Now, does an investor pay more or less than a home buyer? Less, but they don't do the inspection, they don't do the hassle. So you might be able to get $400,000 from an investor and $425,000 maybe from a hopeful family or a couple or a buyer that just has a love for that neighborhood and that house in particular. Either way, you're still underwater by $75,000 to $100,000. So $400,000, $425,000. Then once we get the contract, we get it for $425,000, but we owe $500,000. Then we hire what's called a short sale negotiator to put in, to propose it to the bank. Then they're the liaison between the bank and you is the short sale negotiator. And their job is to present all the documents to the bank to say, we have a buyer willing to close on the property, even though it is less money than what is owed, you're gonna take a loss, but it's gonna be off your books, meaning that it's gonna be an asset, not a liability. Because remember, the bank has been lending this $500,000 over a period of time and they haven't gotten anything in return. Maybe some payments here and there, but they want their $500,000 or something close to it. So just like in the stock market, sometimes you have to take a loss, and that is what a short sale is. It's the bank agreeing to a loss. And what you need to do that is do one thing, is bring a qualified buyer to them with a qualification letter, and there's certain documents like a short sale contract that your agent will prepare and they will present it to the bank. Now, whether that bank is willing to take a loss on it is up to the bank. So some banks are notorious for holding on to their ground and saying, no, we'll foreclose on you, which does affect your credit. And once you're foreclosed on, then the bank repossesses it and markets for sale because maybe they think they could get $700,000 instead of 400,000, 425, what the buyer is asking for. So that's why it's important to get a realistic price. A realistic price is dependent on the market. You don't want to undervalue the short sale because then the bank is not going to take it. They rather just go through the foreclosure process, meaning taking full ownership. Right now they have 50-50 interest. The bank owns 50% and the owner owns another 50%. But they want to take over that 50 and make it that 100% because the owner is not performing, they're not paying off the loan. So again, you want a realistic price for the short sale. Once the bank agrees, it's called an approved short sale. When the bank and the client agree on a price, they may give you some money to relocate if you're living in the property, or if you're not living in the property and it's an investment property or an estate, they're not going to give you any money to relocate. What buyers should be looking out for when short sales? It's usually a deal. You're usually getting a house for under market value. And that's because the house is in not so great condition. Also, you have to be willing to go through the process, the short sale approval process. The negotiator, the bank usually takes 30, 60, 90, a half year, a long time to make their decision to whether take a loss or to foreclose on the property. And owners, you have to have someone that's in your corner, able to fight for you and your behalf to make sure that you're getting the best deal. And that's usually for the money that you're able to relocate to somewhere else that's convenient for you. Even though you're not making money on it, you still are able to get, again, some cash to help you out. So short sales, in sum, is selling for below what you owe on it. So in our case, it was owed $500. We sold it for $400, but the owner benefited. They didn't take the loss, the bank did. And that's it for short sales. Join me for the next episodes. We're going to be talking about probate sales. We're going to be talking about neighborhoods and a lot more. So subscribe, comment. Love to hear what you think. Thanks.